Hi everyone, welcome back to the Strategica channel. My name is Lagato Skansi, your investment and financial advisor. Do remember that Strategica is licensed by the Central Bank of Lesotho. So today we're going to be talking about loans and in particular how you get charged your interest rate. So before I start, I would like you to run quickly, grab your own loan agreement or contract and then come sit so that then we can actually get started. So do press that pause button. So all the returning viewers, we welcome you back. Thank you so much for the support, and for the new viewers, do form part of the family. So hit that subscribe button and the notification bell so that you get notified each time we post new content. So in particular, what I want you to look at in that loan agreement or contract is where it talks about your interest. So most times people do not pay attention to this when they're taking out a new loan. It is the section that talks about the type of interest that you are charged. So normally you are either charged a fixed interest rate, meaning that during the duration of your loan contract, so let's assume that I took a 3-year loan, it means if I am charged 10%, my interest will stay fixed at 10% for the entire 3 years. If on the other hand I have a floating rate, floating meaning that it is changing and it is linked primarily to the prime rate, it means that it is changing when the prime rate changes. So do stick around so that I break it down for you, so that the next time you're watching the news or listening to the radio or reading the paper and you hear that the prime lending rate has gone up for a certain bank, you know how that affects you and how that gets determined. So the repo rate or the repurchase rate, so equivalently in Lesotho we have it as the CBL rate. So this rate is determined by the Monetary Policy Committee. So this is where the fancy economists like Mem Khanso sit, and then they discuss the different issues that affect inflation. So the way that the repo rate or the CBL rate works is that it is there as a part of a monetary management policy to control inflation. So in June in Lesotho, the inflation was sitting at 8.8%. So in order to reduce consumer spending, we have the CBL rate that has been going up in order to reduce our spending and to bring prices down. So this is one of those things that they use to try to control the inflation within the country. So like I was saying, we have this CBL rate that determines your prime rate. So when you walk into a bank, what you see as a consumer is the prime rate. So the prime rate is determined in Lesotho by the CBL rate plus 3.5%, as the recent pricing directives that started from the 1st of April have mandated. So the way that it works is that if we go into a bank today, the current prime rate is 9%. So because the recent CBL rate has been increased from 4.75% to 5.5%. So that is your prime rate. So now as a consumer, when you walk into a bank, you go in. So let's assume Mem Khanso and I walk into the bank today and we both want a loan for 30,000. So how it works is the bank determines what they call a risk rating. The risk rating is how they say how risky you are, and because of your level of riskiness, this will in turn determine your interest rate. So the interest that Mem Khanso and I are going to get charged is going to be equals the prime plus the risk rating. So even if two people, if Mem Khanso and I today walk into the bank and we both want the same loan, which is the 30,000 personal loan for example, but given our different risk ratings, we might get different interest rates at the end of the day. So this is because our riskiness might differ. So this is determined by our age, our marital status, our occupations, and our credit history. So let's say for instance myself, I have defaulted on my Jet account. I know that is a very popular one. I haven't paid my Jet account, and as you can hear, the phone is going off. A message is coming saying you need to pay Jet. So I need to pay Jet, and I have skipped my car installment here and there. So I have in general a bad credit history. And Mem Khanso on the other hand has a clean sheet. She's never taken out any credit. She's still young, even though the fact that she's single might work against her because then she's not married, because there's no security, the other person that can pay for that. But generally, given what the scenario that I'm painting, Mem Khanso has a better risk rating than I do, because in general she hasn't tainted her credit history, so she will have a lower risk rating. And then myself, who has been reckless in terms of paying off my loan installments and my other commitments, I have a higher risk rating. So what that generally means is I might get a risk rating of 10%, and Mem Khanso on the other hand might get 5%. And if you use that formula that we just said, that the total interest rate or my interest rate will be equal to the prime rate plus my risk rating, my total interest will be higher than what Mem Khanso gets, because hers is at 7% plus 9, which is what, 16%, and for me it's 9 plus 10, which is at 19%. So that is how it normally works. So it means that given the risk rating that a bank uses, on a particular day, two people walking into the bank asking for the same loan amount will work out with different interest rates. I know I've said quite a mouthful, so I'm going to try to make it much simpler by putting it into an example. So as I was saying, we said what you see at the end of the day is what we call the prime. And we said the prime in Lesotho is set by saying it is the CBL rate plus 3.5%, So this means that whenever the CBL rate goes up, the prime also goes up. And that in turn means that your interest rate goes up. And when your interest rate on the loan that you have goes up, it means that your loan installment increases. So most people know that the MPC set in Lesotho on the 26th of July and raised the CBL rate from 4.75% to 5.5%. So equivalently, it went up by 0.75%. So the monetary policy committee normally sits on predetermined days, and for the remainder of 2022, they're still yet to sit on the 27th of September and the 29th of November. So do look out for those dates, and we'll also be posting posts on our social media pages to show you how the CBL rate has changed after that meeting has set, so that we keep you informed of the changes. So if, for instance, we say, given the last scenario when the MPC meeting was held on the 26th of July, our current CBL rate was 4.75%, and let us assume that my risk weighting at that point was 5%. So equivalently, it means the entire interest rate on my loan was 13.25%. So subsequent to the meeting that set on the 26th of July, the CBL rate went up to 5.5%. So this means that the new interest on my loan is now the 5%, which is the risk rating. That does not change because this was determined when I took on my loan, as I had explained earlier, and this is 5%. So if I add that to the current prime, which is now determined by the CBL rate, plus 3.5%, which now is 8.25, it means that my new interest is now sitting at 14%. So normally, when it comes to such things, when we say that the CBL rate has gone up or the repo rate has gone up, it affects the prime. So as it affects the prime, it in turn affects your loan, because if you are using that floating rate or the interest rate on your loan is linked to the prime rate, it means whenever that changes into the prime, that also affects your loan installments. So do look out for these things. I know it is quite a mouthful, and most of us might not even actually understand what I'm saying now. So as I have said, grab your loan contract, put it in front of you as you're going through this video, so that then as we discuss each point, you're able to see what I'm saying and what it means for you. Remember, everyone, if you are finding this information, as I have said, I know it is a lot to take in at this point in time, so rewatch, pause, do whatever it is that you need to do, and remember to grab your loan contract so that as I'm talking through this stuff, you can see what it means for you. So, but as I was saying is, normally when we hear in the news that the CBL rate or the prime rate is going up or down in some instances, for people who have floating rate or prime linked interest rates, this is what affects them, and this affects the loan installment that they are charging, in particular the interest portion of their loan repayments. So for people with fixed rates, on the other hand, they won't be affected by the information that I'm sharing today, but I'm just sharing so that the next time you walk into the bank, you know what you're being charged. And people, we need to start entering into conversations where we can ask the consultants in front of us whether I'm being charged a fixed rate loan, and if it's a floating rate, and ask what the relevant rates or the prevailing rates at that particular point in time are. Because if, for instance, let's take for an example, if I have a floating rate loan, and we know that during COVID the rates were quite low, and the CBL rate, hence the prime, during that period was way lower than what it is now. And as we are seeing the interest rates are going up, now we are seeing the prime lending rates or the going up as well. So as that is happening, as we are saying, currently our prime is sitting at 9% in Lesotho. Previously it was sitting at 8.25. For a person who is paying a loan that has a prime linked interest rate, it means I was paying lower during COVID when the rates were even lower than the 8.25 or the 9% that we are currently talking of. For a person with a fixed interest that has been fixed during COVID as rates were lower and it was fixed at 12%, this person has been paying the same interest rate even when people who are paying the floating rate or the prime linked rate were paying lower. So this means that for people who are paying that the floating rate, they benefited from the lower interest rate, and for the person with their fixed interest rate has been paying lower, even the other ones were benefiting on the other side. So it's very important that we start asking these questions as we are talking to the consultants or the credit lenders in front of us, so that we know what it is that we are getting, because at the end of the day we want to get the most out of our loan contracts and try to make the most out of whatever contract or situation that we are in, because at the end of the day we are trying to drive affordability. Because if I'm floating rate and the interest rates are lower and you are at a fixed rate of 12%, you are generally paying more than what I'm paying. Only when the prime goes over 12%, and let's say now the prime is now at 13%, will I be paying more on the floating rate than on the fixed rate. So it's quite nice to also put everything in comparison so that you know what it is that you're paying, what it means to you, which one is cheaper, which one is more affordable. So I know that I've shared quite a lot today, but like I'm saying, if you do need assistance, you can contact us, leave the comments or questions down in the comment section down below so that we can answer them to the best of our abilities. But if you do need more help than what we can comment on, please do contact Strategic Wealth Managers. We are always here to help you and to walk the financial journey with you. So with that said, thanks for watching, and I'll see you next time.